Well, when should you take a look at your 401k plan? Today we're going to take a look. Stay tuned to Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, I have an answer for you. Just go to the website at www.prudentmoney.com. Send that question in and I will get it taken care of for you. Very easy to do, and I do answer my questions. I do my email, that do come into the site. So a great way to get information. We want to be a resource there for you at prudentmoney.com. Well, how about a little bit of Pop Culture Monday? You know, I like to take the articles and the information that's put out by Pop Culture Finance and give you the other side of the story so that you can look at both sides and figure out which makes the most sense for you and really where God is leading you as a steward of what he has given you to manage. So I came across what I think is the perfect article for this day and time because unfortunately, I think we're heading into a marketplace that's going to be pretty volatile. And what I mean by that is this idea of, or this notion of, don't check your 401k plan when the market is falling and it's declining and it's in a bear, pretty much in a bear market or a crash mode, like I like to call it. Remember, if the stock market, and I'll give you the old terms. I've actually expanded these for what I think the market is like today, but I'll give you the old terms. 0 to 10% is something that a 10% loss at any given time is something as a stock market investor you should be able to handle. 10 to 20% is what is called a correction. And 20 and above percent is called a bear market. That is, if it lasts for a long time. If you look back at the COVID, I call it the COVID crash in the stock market, March to April 2020. You'll see it didn't last very long and it recouped the losses real quick. I would call that a crash. I wouldn't call that a bear market. Of course, there's a lot of people who disagree with that, but that's the way that I call it. So looking at your investments might cause a little stress and anxiety. And they're saying why checking your 401k can sometimes be a bad move. It says essentially when we check our investments during a downturn and see that our portfolio values have sustained some loss, we panic and think we need to take action in order to preserve our money. This often means selling some assets, sometimes at a loss, and reinvesting the money when the market is doing well again. Now, keep something in mind, is that you can sit there and look at, say you have a portfolio of 12 or 14 different investments. You can sit there and make a inventory of the ones that are down. If you sold right now, that might be the ones with the biggest losses. I would look at your portfolio from the, overall and look at where the gains, the losses are. But I would look at investments that have not done as well historically. You know, we buy investments based on the information that we look up and research on them. Sometimes they're recommended, of course, by advisors. And you really want to see what they've done in past situations that are tough. If a market has dropped 45, 50%, I think it's a little too late to trim, to take a risk and sell some of the investments so that you can reduce the risk. Maybe at that point you want to stay put, hoping that this falls within the historical norms and doesn't get to where it falls even below 50, 55, 60, 65%. Because the more that you tack on there as you fall, the way more it takes to get back when you're trying to recover. But they tell you the danger of checking during peak moments is that cognitively you anchor on that really high number as if you have that money in the bank. But if the market is down tomorrow, you will feel like you've lost money. There's a whole demented almost psychology that goes along with money, how we look at it, how we attack it, how we think about it, and emotions are key. And emotions can really drive the decision-making process. And one of the things we always talk about is make sure that you are filtering the information and what you're seeing through a lens of non-emotion. You don't want to filter through emotion, because if you do that, you'll be making rash decisions, which you probably not going to be a good idea. So you really want to make them with a clear head. You want to get some information, see your advisor, talk to other people, and really pray about it and get to a good decision. Now, granted, when the market is falling, it sometimes moves fast. And by the way, I'm not talking about, there's really a couple of two different things going on here. The first thing is, if you decide to sell an investment and you put it into cash or you put it into another fund that's lower risk or whatever you do, you're not trying to time the market. You're trying to reallocate and reduce risk. That's all you're trying to do. Pop Culture Finance will call that you are timing the market, and you never want to time the market because it's pure luck. I would totally agree with that. Although I think that a small percentage of that can be researched and get a pretty good idea of when the market might turn around. But it's a small percentage. It really does come out to luck, and I totally agree with that. But this is not about timing the market. This is about reducing risk. And if it's bothering you, if it's bothering your health, if it's keeping you up at night, that I guess it's one of those things where we're talking about the 401k plan, and should you sell? Are you having a tough time not going to see it, avoiding it? There's always a little bit of anxiousness and a little bit of hesitation when the market is not a good market. But if it is affecting you from the standpoint of your health or anything like that, then you really probably are taking too much risk. So that's just something to keep in mind. The other thing is, if you're selling an investment, there's also a difference between selling it and put it in cash where it sits versus selling it and moving it to something that's lower risk. Now, oftentimes you don't have that ability to do that in a 401k plan because it's so limited. But I think can be a better deal because that way you're staying in the market. You're just at a reduced risk of doing so. So the next paragraph: when should you check your 401k balance? And before we go to that, I remember this as for yesterday. John Bogle, who is a legend on Wall Street, started Vanguard funds back in the 70s, I believe. Actually, do you know? I think that the oldest mutual fund dates back to 1921. For those of you who might even have this fund, the Investment Company of America. I may be off a little bit, but that is a very, very. It's held American funds. It's I think the oldest mutual fund, if not the oldest. It's one of the oldest. Sorry, I got off on a little bit of tangent there. I was talking about John Bogle, and John Bogle, like I said, he's the pioneer of mutual fund investing, starting back in the 70s with Vanguard mutual funds. And of course, you have to understand where he's coming from. He's a big buy and hold. You never sell. You ride it out and that kind of thing. And I'll never forget this because I hold him. I was blessed to get the opportunity to to interview him on a couple of radio shows. He came on the program, and I just have a lot of respect for him. He passed away maybe 3 or 4 years ago, but he used to always say, I remember this as if it were yesterday, they'd have John Bogle on like CNBC, and this was during the financial crisis, the market was dropping, and he said, I got the best strategy for you, something like this, but he goes, I got the best strategy for you when it comes to investing, and that is, don't look at your statement. And then he would say, it's all noise, and the markets will come back. And that can be true and all, but I still think that it's extremely important to be able to look at your investments and be able to look at the risk and what's going on and be aware of it, because it might cause you to make some decisions that wouldn't be a bad idea to make. So always keep that in mind. But I always thought that was interesting that he would say that, because and really, if you look at any decision, when it comes down to reducing risk, getting out of the market, getting into the market, it's all a roll of the dice. And to a degree, I mean, I think you can put some things that back that up, but there's a point where you have to just go with your convictions and do things the way that you think God's leading you. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. We're up against a break. Stick around, and I'll be right back. Hi, my name is Bob Brooks, host of the Prudent Money Radio Show. So let me ask you a question. Do you know your numbers? Now, which numbers are those? They are your retirement numbers. That set of numbers is the single most important planning numbers you can know. Yet the majority of Americans don't even know them. Prudent Money Financial Services, sponsor of the Prudent Money Radio Show, specializes in figuring out those numbers and creating a game plan to make sure you're on the right track. Listen to the Prudent Money Radio Show weekdays at 3 p.m. on Bible School Radio 91.3.
Hi, I'm Jill Taylor, inviting you to join me each Saturday morning at 11 o'clock for Choose Life Radio. You'll hear people from across America sharing their stories of faith, forgiveness, redemption, and restoration. Choose Life Radio will encourage you to fully appreciate the gift of life. You may also find help for you or a friend in need. So please join me Saturday mornings at 11 o'clock right here on Bible School Radio 91.3.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Hey, if you got a question for me, go to the website at www.prudentmoney.com and just send it in. Send me an email. I'll get you taken care of. If you need to schedule a phone call, we can take a call and do that as well. Bottom line is we want to be a resource for you, and we can do that through the prudentmoney.com website. We're talking about, is there are times that you should look at your 401k and times that you should not. We took most of the balance of the first half of the program talking about what Pop Culture Finance says about sometimes could be a bad move. If you are wrapped up in emotion, you've taken you're in the wrong risk level, it may be difficult to really look at and see what you've done, but I think it's important to make to take that time to really look and see what has happened, and if there's any moves that you need need to make. This is to me, and obviously there's a bias alert here, but this is to me why it's so important to have a relationship with a financial advisor, because they can walk you through this process. And if you're a buy and hold person, the way that you look at investments really needs to match with the way the advisor looks at investments, or there's a happy medium, because it's that can only end up creating way more risk if you're not careful. So when should you check your 401k balance? It says, while focusing too much on the ups and downs of your 401k can be counterproductive, remaining completely oblivious to your retirement portfolio isn't something that's recommended. And there is so much truth to that. I know of many people through the years that I've met that will go to the mailbox. If they don't get it, of course, now people get it online. But back then, maybe 10 or 15 years ago, they would go to the mailbox, take the statement out, throw it in a drawer, and that was their way of coping with their investments, or that's the way that they know that they're going to check those investments at some point. Because I know of a individual. He literally every January 1st, and it's funny to hear him tell the story, but every January 1st, he walks into his office at his home, sits down, pulls everything out, looks at it for 5 minutes, and looks at all the statements he hasn't opened, and he puts it back, and then he walks away. He goes, I do it every single year. So don't be oblivious, that's for sure. Look at how you're doing compared to where you need to be right now to reach your goals in the future. Okay, so this is where this Fidelity information comes in. We talked a little bit about this last week. They suggest at age 40, you should have 3 times your income saved and accumulated in an investment account. By age 50, 6 times your income. By age 60, 8 times your income. And by 67, 10 times your income saved by 67. And I mean, it's better than nothing. But I think that you could do so much more with the planning end, and we've talked about this quite a bit. But these numbers may work and they may not work. Who knows if 10 times your income is? I mean, who knows if that's even feasible to last you through retirement, based on what you want to do in your retirement. See, that's just like a baseline starting point, and I think it makes sense to take it way further. You know, the system we talk about is 4 steps. First, you plan, you set your goals. And when I say plan and set your goals, that means that you're able to say at age 65 or age 66 or 67 or wherever your age, whatever age you're shooting for, I plan to retire and I plan to have X amount of dollars saved. And I plan for that X amount of dollars to average, say, 6%, 5%, 7%, whatever, over the next 20 years that I'm going to need to accumulate money and live my retirement for 20 years. At the end of that 20 years, if I still have money left over, great. If I don't, but I'm shooting for the 20-year mark. And to get there, I know that I have to save X amount of dollars a year, and I need to invest X amount of those dollars, and I need to average, say, 7 or 8% a year. And that kind of detail to be able to go through. And the other thing too, which this falls real short. Okay, so if you have 10 times your income saved by 67, so you've accomplished that. What do you do at the point that you start taking money out? Do you stick with 4% or 5%? Do you think has your investing gotten overconfident from an easy market, and you're trying to get 10% or 8%? You feel like you don't need a financial advisor. That's fair. But it's always this is where I think a financial advisor really does pay off, and definitely in that 5 to 10 years before retirement and then on afterwards, because there's so many things that comes up and you always need opinions. So that's always kind of been my issue with, so what if here I am, I've got 10 times my income saved by 67, now what? So where do I start? First of all, we talked about this. If you are dreading checking your investments, you're probably taking too much risk. And this is why it's so important to get an idea of how you emotionally react to risk and loss. I was talking to somebody not too long ago, and she made the statement that she wouldn't be able to sleep at night if she lost X amount of dollars in a month's time. So we dug a little bit deeper, asked a lot of questions, and come to find out her risk level was not that drastic. It was probably more of a conservative to a moderate type investment, a conservative to a moderate investment risk level, which is very reasonable and can work. So you need to get an idea how you emotionally react to risk and loss. Number 2, making changes is reallocation to reduce risk and not market timing. We've already talked about that. Once again, I think that if you stay involved and you learn and your goal and intention is to learn how money works, how investments work, that you are able to make these decisions much better versus blindly making decisions. And for instance, what if you're 1 year out from retirement and your retirement account takes a 30% hit? Didn't even have time to rearrange anything. All of a sudden, you're down 30%. If you're really in touch with your investments, if you're really in touch with the decision making, controlling your emotions, you are in a situation where the odds are with you that you're going to make a better decision. And if you don't, you can always correct that decision until you do make a good decision when it comes to your investments. And then looking at it from the standpoint of the 10 times your income saved by age 67 or retirement, I mean, that's a very light foundational way to look at things. And like I said, that's better than nothing. But at the same time, just like I just said, I think it's important to make sure that you've got a real good handle on your investments and on the amount that you definitely need to have and the decisions that you have to make, and making sure that you are dialed in on really how much risk is out there and knowing when risk is getting high. And that's not always easy to do. I'll be the first to admit it, but I think it's better than not doing something at all. And it also, not to even confuse you even more, but I think it also makes sense to know when not to do something, know when not to take an action. And, one of the things that I think is important to do is really evaluate what you value. Once again, not through emotion, even though they are linked, obviously, but through a filter of making clear-headed decisions. And this is where a financial advisor can obviously come in and be a great help, because it's not an easy decision to make. But if you make that decision, you make it, you go forward. And if you revisit it again, I say every 3 months or every quarter, and make sure that you are on the right track, and to make sure that you're going to arrive at retirement safely. And then once you get to retirement, that's a whole nother planning issue, but one that's a little bit easier to manage and navigate because, well, you're at retirement. But But if you've done it right, if you've accumulated the right amount of assets, you can get by with taking just enough risk, but not too much risk that's going to keep you up at night or is going to be a stumbling block along the way. So I hope that helps a little bit. If you've got any questions, you can always go to the website, info@prudentmoney.com, and send it in to me. I often get asked, what's the most important age period before retirement? And I always say it's 5 to 10 years. It's when you really want to make sure that you have it all together. Hey, this is Bob Brooks. You got a question for me? Please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.